The S&P TSX Composite closed up more than 350 points on Monday, led by basic materials, while the United States sat out for Memorial Day. That is a thin volume session. When large buyers are absent, moves can reflect positioning rather than conviction. And yet the Canadian energy sector's 2026 story does not need Monday's session to make its point. It has been making the same point since January. Canadian oil and gas stocks are up 46% as a sector in 2026. Cenovus Energy is up 84% year-to-date, closing at a 52-week high of $42.41 as recently as May 15th. Net earnings grew 83% year-over-year in the first quarter. Free funds flow climbed 124%. The board approved a 10% dividend increase. By every operational measure, the thesis looks unassailable. The complication entered the market Sunday evening. U.S. crude futures fell over 6% on reports that the United States and Iran are moving closer to a deal that could reopen the Strait of Hormuz. A confirmed report from Yahoo Finance Canada and Reuters put crude down nearly 7% in a single session. That is not a correction in energy pricing. That is the war premium, the very premium that underwrote the entire 46% sector gain, beginning to decompress. Here is what that means for a domestic investor holding Canadian energy names. The fundamental story at Cenovus has not changed. Production records stand. Refining margins are intact. But if the price of the underlying commodity that justified those record cash flows re-rates down on geopolitical resolution, the earnings growth that the market is paying a premium for is still real, only the multiple on top of it is not. Cenovus Energy achieved its highest ever quarterly upstream production in the first quarter of 2026, reaching 972,100 barrels of oil equivalent per day, up 19% year-over-year. That is an operational fact. The $2.2 billion in free funds flow for the quarter is real cash. None of that is in dispute. What is in dispute is the price assumption embedded in those numbers. Cenovus CEO John McKenzie said in early May that Canada has an unprecedented opportunity to produce more oil to meet global demand. The operative phrase is global demand, specifically, demand shaped by the Middle East energy crisis that the International Energy Agency described as a, quote, major economic and energy challenge for the world. Remove the war premium from global oil pricing, and the revenue line at every Canadian energy producer re-rates, even if production volumes hold. The supporting case sharpens the picture. Canadian National Railway, which moves oil, grain, coal, and fertilizer across the country, has seen its shares rise 16% in 2026, even though management guided 2026 earnings roughly in line with 2025's flat result. The $350 million tariff headwind is still active. QSMA negotiations are expected to blow past the July 1st deadline. CN's bargain hunters moved into the stock this year, anticipating trade resolution. Not because the business fundamentally re-accelerated. That positioning works when geopolitical tension stays elevated and commodity flows remain robust. It stops working when both assumptions shift simultaneously. Kraken Robotics, Canada's subsea defense technology company, has seen a hypothetical $100,000 investment from December 2024 grow to over $295,000. Canada is negotiating a $12 billion submarine contract between Germany's ThyssenKrupp and South Korea's Hanwha Ocean, with a finalist expected in June. Canada's defense spending surge is explicitly tied to NATO rearmament and Arctic sovereignty concerns that intensify in a world where geopolitical competition is rising. A broad de-escalation signal from the Middle East does not automatically deflate Canadian defense budgets, but it changes the urgency argument that drives accelerated procurement timelines. The mechanism is not complicated. Canada's 2026 equity premium is concentrated in sectors energy, defense, materials, and railways that benefit simultaneously from three overlapping geopolitical tailwinds: the Middle East energy war, the Canada-U.S. trade confrontation, and NATO rearmament. Those three tailwinds are not independent. They all trace back to a world of rising great power competition and supply chain fragmentation. A credible de-escalation signal on any one front changes the probability distribution on the other two. The participant timing gap is visible in the flow data. Cenovus and the broader energy sector moved first, with institutions front-running the commodity boom in Q1 2026. Retail and income-focused TFSA investors followed, with articles circulating this week about TFSA benchmarks of $109,000 and covered call ETFs yielding 9.8%, designed to capture energy and bank dividends. The income-seeking retail layer entered later, and is the segment least likely to have modeled a rapid geopolitical resolution scenario into their holding thesis. The unresolved question from the session is not whether Cenovus's operations are impaired. They are not. The question is whether the 84% year-to-date gain already reflects a commodity price level that requires the Middle East conflict to persist indefinitely. If WTI crude drops from the $70 plus range toward the $60 threshold, the approximate level at which Canadian heavy oil producer margins begin compressing meaningfully, the sector's free cash flow story deteriorates faster than the production story. The historical parallel is the 2022 to 2023 transition. Energy stocks surged through 2022 on the war premium following Russia's invasion of Ukraine. When European gas found alternative routes and supply-side fears partially resolved, energy equities derated from their peak multiples, even though the underlying commodity remained elevated relative to pre-war levels. The re-rating did not require oil to collapse. It only required the marginal war premium to leave the pricing. Canadian energy in 2026 is in an analogous position, with a larger percentage gain already embedded. The conditions for continuation and for breakdown are both visible. On the continuation side, the Iran deal reports remain unconfirmed. Multiple prior rounds of U.S.-Iran negotiations have collapsed. If the Strait of Hormuz remains effectively constricted, or if the talks break down, the war premium returns, and Cenovus's 2027 growth plan, which includes the Christina Lake North expansion adding 40,000 barrels per day by 2028, gets priced on a higher commodity curve. The Canadian energy sector's plus 46% this year could extend if production growth meets sustained pricing. On the breakdown side, the confirmation threshold is a formal Iran deal that reopens the strait and lifts secondary sanctions on Iranian oil exports. Iran's pre-sanctions capacity was roughly 3.8 million barrels per day. Even partial restoration of 1 to 1.5 million barrels per day into global supply would structurally lower the equilibrium price range, not for a session, but for a quarter or longer. That scenario puts the 84% gain at Cenovus in question, not because the company's fundamentals deteriorate, but because the premium multiple on top of those fundamentals contracts. The verification benchmark for the next session is straightforward. Watch WTI crude's response to any official confirmation or denial from the U.S. State Department on the Iran negotiations. A denial sends energy names higher. A confirmation, or even an official acknowledgement that talks are advanced, tests whether Cenovus and the sector can hold above their recent 52-week highs at $42.41, and at the sector level, hold the 46% gain intact. The deeper question persists beyond any single day's oil print. Canada's 2026 rally is concentrated in sectors that share the same geopolitical foundation. If that foundation cracks at the energy leg, the railway names, the defense procurement cycle, and even the materials sector face a reassessment of the tailwind assumptions that drove positioning earlier in the year. The money that moved first into Canadian energy is not the money that will wait for official confirmation, and the TFSA income investors who followed them in may not see the exit signal until the multiple has already moved. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.